So welcome back. In our last video, we introduced the Rockefeller Method, and we got so many questions about that cash value life insurance component. And a lot of you are probably skeptical. So today, Rick is back to explain exactly how this works and why it's such a critical piece of this strategy.
I'm glad we're addressing this because there's a lot of misinformation about cash value life insurance.
It is.
Many people have been told buy term and invest the difference. And for some, that might be appropriate advice. But for the Rockefeller method, we're using cash value life insurance in a very specific and strategic way.
So can we start with the basics? What's the difference between term life insurance and cash value life insurance?
That's a great question. Term insurance is like renting. You pay premiums for a set period of time, maybe 20 or 30 years. And if you die during that term, your beneficiary get a payout. But if you don't die within that term, the policy expires and you get nothing. It's pure protection. Cash value life insurance is like owning. You pay premiums, yes, but part of those premiums build cash value inside the policy. The cash value grows tax deferred and you can access it during your lifetime. Plus, the death benefit is guaranteed for your lifetime.
Okay, so it's two components, the cash value and the death benefit. Can we talk about the cash value first? Because that's the part that people can use while they're still alive.
Great place to start. When you pay your premiums into cash value life policy, part of it goes towards the cost of insurance.
Mm-hmm.
Part of it goes to the insurance company's operating costs.
Okay.
And the rest builds cash value.
Okay.
Over time, this cash value grows and also pays interest, which accelerates the growth.
So how much does it grow and what kind of returns are we talking about?
Typically, you're looking at returns between 5 and 7% annually.
Mm-hmm.
Now, I know to some people, they're thinking, I can get better returns in the stock market. And you might be right. But here's what you need to understand. This isn't about maximum returns. It's about the tax advantages and liquid growth.
So explain this liquid part because that's really important, right?
It is extremely important. Let's say you have $100,000 in your cash value life insurance policy.
Okay.
You take a loan against that money. Typically 90% you're able to borrow of the cash value and use it for whatever you want. Start a business, buy some real estate, or pay for your kids' college education.
Okay. But it's a loan, so do you have to pay it back?
Here's where it gets interesting. You don't have to pay it back, but you should if you want to maximize this strategy. When you take a policy loan, the insurance company is actually lending you money using the cash value as a collateral.
Okay.
Meanwhile, your cash value continues to grow as if you never took a loan out.
Wait, so my money is growing even though I borrowed against it?
Exactly. It's not like withdrawing money from a bank account, where the balance goes down when you take that withdrawal. Your full cash value stays in the policy earning interest. Okay. You just have a loan balance that you can repay on your own schedule.
Man, this is blowing my mind. So I literally could take out $50,000 and start a business, and my full cash value is still in there growing?
Correct.
Okay.
And here's the kicker. When you pay back that loan with interest, where does that interest go? In the Rockefeller method, it goes back to the family trust.
Okay.
You're essentially paying yourself interest instead of paying it to a bank.
So the family becomes their own bank. That's why we say your money never stops working for you, right?
Yes. Though being your own banker is a broader concept that can exist without the Rockefeller trust structure, but you're right. The principles are similar. You're creating your own financing system instead of being dependent on banks.
Okay. So then let's talk about the death benefit side. How does that work in this strategy?
This is where it becomes truly multi-generational.
Okay.
Let's use an example. Say your grandfather sets up a cash value life policy on himself. with a $1 million death benefit. That trust owns the policy, builds up cash value that the family can use. When he passes away, that 1 million comes into the trust completely tax-free.
Wow, tax-free is huge.
It's massive.
Wow.
That's often more valuable than the actual dollar amount. Now, here's the waterfall effect. That 1 million doesn't just sit there. The trust uses it to purchase policies on the next generation.
Wow.
Maybe 3 policies on the children for $333,000 each.
Wow. So the money is cascading down.
Exactly. And when those children pass away, their death benefits flow back to the trust and purchase policies on the grandchildren. The money never leaves the family system and just flows from one generation to another generation, constantly replenishing and growing.
But what about while the people are alive? Can they use the cash value?
Absolutely. That's the beauty of it. Each generation can access their policy's cash value for education, starting businesses, buying homes, all major life events.
Wow.
They take loans, use the money, and ideally pay it back so the next generation has even more.
Wow. So you mentioned overfunding these policies. What does that mean?
It's a great question. The Rockefeller Method, you don't just pay the minimum premium. You overfund the policy, meaning you put as much money as the IRS allows without triggering tax consequences.
Okay.
This dramatically accelerates the cash value growth, especially in the first 3 to 5 years of the policy.
So you're front loading it.
Exactly.
Okay.
By overfunding early, you're creating much larger cash value that compounds over time. Think of it like retirement contributions. The earlier and more you put in, the more time it has to grow.
Okay. So let's talk about a real scenario. Say I'm 35 years old and I want to start this for my family. What would that look like?
That's a great scenario. At 35, you're at an age where the premiums are relatively affordable, but you have time for significant growth. Let's say you qualify for a $500,000 death benefit.
Okay.
Your annual premiums might be around 10 to 15,000, but you decide to overfund and put 25,000 per year for the first 5 years.
That is a significant commitment.
It is, but look at what you're building. After 5 years, you might have 110 to 120,000 in cash value.
Okay.
That's money you can access anytime. By age 65, you could have 600 to 700,000 in cash value, plus your $500,000 death benefit is still there.
So, and then when I pass away, that death benefit goes to the trust and buys policies on my kids?
Exactly.
Wow.
And because you'll likely buy policies on your kids when they're young, let's say age 5 to 10, their premiums will be much lower. Wow. A $500,000 death benefit on a 10-year-old might only cost $3,000 to $4,000 per year or less. So that $500,000 death benefit could fund multiple policies for the next generation.
Okay. So this is starting to make sense to me, but I have to ask, what are the downsides? What could go wrong?
Good question. First, you can't afford to keep up with the premiums. The policy could lose benefits. Second, if you take out loans and never pay them back, the policy could lapse. Third, if you don't set up the trust structure correctly, you could lose some of the tax benefits.
So this requires commitment and proper structure.
Absolutely.
Okay.
This isn't a set it and forget it strategy. It requires intentionality, financial discipline, and professional guidance. But when done correctly, it's one of the most powerful wealth building tools available.
Wow. Okay. Last question. How do I know if this is right for me and my family?
Great. Ask yourself, am I thinking multi-generationally? Do I want to leave a lasting legacy?
Yeah.
Am I willing to commit to a long-term strategy? And do I have stable income to fund these premiums? If the answer is yes to those questions, this strategy deserves some serious consideration. But work with advisors who understand this.
Perfect. So everybody, in our next video, we're going to dive into the trust structure, how it works, why it's necessary, and how to set up one correctly. Rick, thank you again for taking this time to break this down.
My pleasure. Remember, the Rockefellers thought in terms of centuries, not quarters. That's the mindset shift that makes this work.
I love it. Listen, y'all, I need you to subscribe or hit that bell, and we'll see you in the next one. Remember, I'm Juanita Stevens, and I'm a financial advisor I'm the owner of J. Stevens Wealth Management, JSTEPHENS, jstevenswealthmanagement.com, or you can give us a call, 512-598-9080.